Profitability and Management first session. In this session, we are going to look at the uh, uh, the concepts of accounts payable, the key components of credit terms, and the procedure for analyzing those terms. We'll also try to understand the effects of stretching accounts payable on their cost and use of accruals. We'll look into interest rates and what are the basic types of interest rate and basic type of unsecured bank sources of short-term loans. So let's jump in. First, we try to understand the concept of spontaneous liabilities. These are short-term liabilities. These are financing that arise from the normal course of business. The two major short-term sources of such liabilities are accounts payable and accruals. Unsecured short-term financing. This is a short-term financing obtained without pledging specific asset as collateral, hence unsecured. The firm normally take advantage of these interest-free sources of unsecured short-term financing whenever possible. Let's see how they do that. So let's look at the accounts payable management. Before we go forward, let me rephrase what we have already studied in. So cash conversion cycle is basically based on inventory, number of average age of inventory. I'm writing on conceptually like this, plus the accounts receivable, which is average collection period, minus the average payment period, which is accounts payable. So this basically refers to average collection period, and this is average age of inventory. Now, if you see, we have already covered account receivable, in which the focus of the firm is to collect faster the account receivable without losing sales. But here in this accounts payable, the focus is to delay as long as possible without hurting the firm's credit rating with the suppliers, hence using suppliers' money to fund the cash cycle. So accounts payable are the major source of unsecured short-term financing for business firms. They result from transactions in which merchandise is purchased but no formal note is signed to show the purchaser's liability to the seller. So it's more of a two-way contract, unsigned contract, and since it's on daily basis, so credit rating or credit between the two parties really matters. So the average payment period has two parts: the time from the purchase of raw material until the firm mails the payment, and payment float time. So this what is payment float time? It is the time the firm takes after the firm mails its payment until the supplier has withdrawn spendable funds from the firm's account. Now, accounts payable management is management by the firm of the time that elapses between its purchase of raw material and its mailing payment to the supplier. So when the seller of goods charges no interest and offers no discount to the buyer for early payment, the buyer goal is to pay as slowly as possible, stretching it without damaging its credit rating. Now, please remember that this credit rating doesn't mean that we want there is a special credit rating done through the credit rating agency. It's more like the trust between the two firms should not be damaged. This allows for the firm use of an interest-free loan from the supplier, because as we stretch the payments, basically we are using the supplier's money to fund our accounts payable, and will not damage the firm's credit rating because the account is paid within the stated credit terms. So let's look at an example. In 2013, BF manufacturer of different beverages brand had annual revenue of 3.8 billion, cost of revenue of 1.8 billion, and accounts payable of 468 million. BF had an average age of inventory of 168 days, average collection period of 55 days, and an average payment period of 136 days. Now, BF purchases were $1.3 billion worth. So what is the cash conversion cycle? So we know cash conversion cycle equals to average age of inventory plus the average collection period and minus average payment period. This comes out to be the 168 plus the 136. Sorry, it's 55, and this is 136, and this gives us 87 as the uh, cash conversion cycle. So we can see the resources BF has invested in this cash cycle. Um, Obviously, we assume 365 days a year. So inventory is 1.8 billion multiplied by the this is average age of inventory divided by the 365. So basically, when we multiply by 1.8 billion, we are taking for every day the daily average age of inventory. So multiply 1.8 gives us the total inventory for this average age of inventory. So this is for 168 days, this is for 55 days, and this is for 136 days. So we see account receivable for $0.57 billion for 55 days, and accounts payables are 1.3 billion. They are outstanding. Their average payment period is uh, average 136, and this gives us the $0.48 billion, which is for 136 days. The total resources invested equals to 0.92 billion. So let's test this by changing the accounts payable. If we increase the accounts payable by 5 days, let's say, then how it will affect our cash conversion cycle. So uh, we already know that BF's average average payment period and average accounts payable, the daily accounts payable generated by BF is about $3.5 million. Basically, it is the, we already know it's $0.48 billion. If we divide by 130, say this is for 136 days. We divide by 136, we get it $3.5 million per day. If we have to increase by 5 days, so you can multiply by 5 days. This 5 days represents the accounts payment period, and this if we increase from the account payable period by 5 days, this will be $17.5 million of suppliers money that will be part of the cash conversion cycle. We can see this in another way also. So cash conversion cycle was equals to 168 plus 55 minus 136 days, and was resulting in 87 days. Now if we have the same conversion cycle, but we increase the accounts payable period by 5 days, then we will have 82 days. So if we can stretch the payment period by 5 days using suppliers money, we can actually reduce our cash conversion cycle to 82 days, which means less of our money is invested in the cash conversion cycle. So the credit terms that firms is offered by its suppliers enable it to delay payment for its purchases. Now, if we go with the Lee example again, Lee is the operator of a small chain of glass stores, purchased $1,000 worth of merchandise on February 27 from a supplier extending terms 210 net 30. Now, 210 net 30 EOM end of month. If the firm takes this discount, what will its savings are? So it will be uh, within the 10 to 30 days, it will earn, if it pays within the 10 days, it will be able to make 2% of discount, and that discount is $20. And the total that the firm is supposed to pay is $980 by March 10, thereby saving $20. Now, the cost of giving up a cash discount is important to be considered. It is the implied rate of interest paid to delay payment of an account payable for an additional number of days. Let's see how does it work. So A firm makes $1,000 purchase on February 27. Credit period begins at March 1. Then if the payment is made within the discount period, which is between March 1 and 10, a 2% discount can be earned, which is around $20, and that would be so a total of $980 will be paid. Gain is $20 saving. But if this is not availed, then what is the cost? The cost comes in the between March 10 and 30, and that is 20 days. This is additional 20 days. So 1000 minus 980 is equal to $20. So we are supposed to pay 1000 here. We were supposed to pay 980 if we availed the discount. So the difference basically, which is $20, is the cost. Now to calculate the cost of giving up the cash discount, the true purchase price must be viewed as the discounted cost of the merchandise, which is 980. So we are not going to consider 1000. We are going to consider what was possible if paid earlier on or by availing the discount. Another way to say is that lease suppliers charges $980 for the goods as long as the bill is paid within 10 days. If Lee takes 20 additional days to pay, then additional $20 in interest has to be paid also. Therefore, the interest rate on this transaction is $20, that is the cost of paying beyond the discount rate, and 980 is the benchmark price, which gives us 2.04% for 20 days loan. So there are two ways to calculate it. One is the standard ways, and the other is the approximation. So in this, what we do is we calculate the annualized interest rate. In order to do so, we multiply the interest rate on this transaction times the number of 20 days period during a year. The following equation provides the general expression for calculating the annual percentage cost of giving up a cash discount. So CD is the cash discount, which is in our case was the 2%, and 100% minus this is 2%, and number of this is basically 30 minus 10. So if you remember, it was if 2, 10, net 30 EOM, which means 2% is the discount and 10 is the paid within the due time, and if not, then there is this. So this 30 is, and this 10 comes here, which is 20 days. In this case, if you look at it, we can calculate it by using the previous formula, which is given here. 2% divided by 98% multiplied by the 365 divided by 20 days. This gives us 37.24% of the cost of giving up cash discount. Now, the other method to calculate is, which is approximate and which is pretty simple, is you can multiply 2% multiplied by 365 over 20 days, which gives you 36.5%. Now this although there is a difference and sometimes this is significant, so obviously it's appropriate to use this standard, but approximation gives you a quick view of what kind of a cost you are incurring in giving up the discount. Let's look at an example. MP, a large building supply company, has 4 possible suppliers, each offering different credit terms. Otherwise their products and services are identical. So besides this cash discount, everything is same. So we see that the supplier A is offering 36.5 for 210 net 30. B is offering 110 net 85, which is 4.9%. C is offering 320 net 70, 21.9, and so on and so forth, with D, which is 29.2%. So if the firm needs short-term funds, which it can borrow from its bank at an interest rate of 13%, so now we have a benchmark. So we can borrow from the bank at 13%. So anything, and if each of the supplier is viewed separately, which of the suppliers' cash discounts will the firm give up? So which offer has to be accepted basically? So if we see in dealing with suppliers A, the firm takes the cash discount because it is 36.5%, and then borrows the fund it requires from its bank at at 13%. So either I can give up 36.5% and borrow the funds at 13% to uh, fund the chain, or fund the process. But since this cost of giving up is greater than the discount, is greater than the um, interest rate or the cost of money that I'm going to pay in order to replace cost of discount. So this is not a good deal. I should be able to use the discount rate. The second is, so I will take the discount rate with the supplier B, where we have the same case, which is 4.9 versus 13%. So I think it's better that I should go for the bank rather than, sorry, go for the bank rather than the cash discount. For suppliers C and D, we have the same case in which we have both C and D cash are cost of giving up discount is greater than the 13%, hence I should take the discount. Now, what happens if we stretch accounts payable? And stretching accounts payable refers to paying bills as late as possible without damaging the firm's credit rating, or what we call the trust. B was extended credit terms of 210 net 30 end of month. The cost of giving up the cash discount, assuming payment of the last day of the credit period, was approximately 36.5. If the firm were able to stretch its discount payable to 70 days without damaging its credit rating, the cost of giving up the cash discount is 12.2%, which means if beyond the set 30 days time limit, it goes to 70 days, we are actually having the cost starts falling down, and it reduces the implicit cost of giving up a cash discount. Let's look at accruals now. Accruals are liabilities for services received for which payments has yet to be made. So the most common items accrued by a firm are wages and taxes. Because taxes are payments to the government, their accrual cannot be manipulated by the firm. However, the accrual for wages can be manipulated to some extent. So what we can do, we can stretch the wages, and then we can invest the same wages um, in a bank account and earn interest on it. Let's look at an example on that. The TC, a large janitorial service company, currently pays its employees at the end of each work week. Weekly payroll totals $400,000, and if the firm were to extend the pay period so as to pay its employees 1 week later throughout an entire year, the employees would in fact be lending the firms $400,000 for a year. If the firm could earn 10% annually on invested funds, such a strategy would be worth $40,000 per year. Look at the short-term self-liquidating loan is an unsecured short-term loan in which the use to which the borrowed money is put provides the mechanism through which the loan is repaid. So, for instance, these loans are intended merely to carry the firms through seasonal peaks in financing needs that are primarily build up of inventory and accounts receivable. As the firm converts inventories and receivables into cash, the funds needed to retire these loans are generated. And bank lent unsecured short-term funds in three basic ways: single payment notes, lines of credits, and revolving credit agreements. So the prime rate of interest is the lowest rate of interest charged by leading banks on business loans to their most important business borrowers. Normally it is linked to what we call LIBOR, London Interbank Offer Rate. So the prime rate fluctuates with changing supply and demand. Banks generally determine the rate to be charged to various borrowers by adding a premium based on the riskiness, and the premium may amount to 4% or more, although more unsecured short-term loans carry premiums of less than 2%. There are two types of these loans: a fixed rate loan, a floating rate loan. In a fixed rate loan, we have the prime rate, for instance 2%. So prime rate can fluctuate. As I said, it's a LIBOR. And then we have a fixed rate of, let's say for 90 days, 1% interest rate. So that will be equal to 3% fixed for 90 days. Now, when we go to floating rate loan, in floating rate loan, we have the prime rate, which is again, as I said, it could be LIBOR, London Bank offer rate. You are encouraged to check what it is on Google it. So it is 2% and plus 2%. So this remain fixed. Here we have the same, let's say 90 days 1%. So this will be 3%. Now next payment period, it will be, let's say 7%. So the total will become 1% equals to 8%, and then it could be 1%, and this can be, the next payment period will be 1% is fixed, so this comes out to be 2%. So it varies, floating rate, while the fixed gets initial jump, but then it becomes an initial increment and then it becomes fixed. So let's look at the difference between the effective annual interest rate and advance, if the interest is paid in advance. So once the nominal or stated annual rate is established, the method of computing interest is determined. Interest can be paid either when a loan matures or in advance. These are the two methods. If interest is paid at maturity, the effective or true annual interest rate, the actual rate of interest paid for an assumed 1 year period, is equal to interest divided by the amount borrowed. And if interest is paid in advance, so technically we only received the amount, the which we are going to use up. We have already paid the interest in advance. So this is calculated like this. It is also called discount loans. Let's look at an example of both. So WCM, manufacturer of athletic apparel, wants to borrow $10,000 at a stated annual rate of 10% for 1 year. So what will be the effective annual rates? So 1,000 divided by 10,000 equals to 10% is the effective annual interest rate. But if the interest is, if this is an advance interest or discounting loan example, then what would happen? So we paid 1,000 in advance. This will be interest rate divided by the amount borrowed plus minus the interest rate. So basically we have deducted the interest from the amount borrowed or principal amount in advance, and what is left is $9,000. And we look at how much we have paid in advance is $1,000. This gives us 11.1%, which means and this makes sense because previously it was 10%, because we were supposed to pay 1,000 at the end of the term, but now we are paying at the early stage, so we are not using $1,000 of the amount borrowed, hence it will yield a higher cost. Then there is a single payment note, which is a short-term one-time loan made to the borrower who needs funds for a specific purpose for a short time period. This type of loan is usually a one-time loan, and the resulting instrument is a note signed by the borrower that states the terms of the loan, including the length of the loan and interest rate. This type of short-term note generally has a maturity of 30 days to 9 months or more. The interest charge is usually tied in some way to the prime rate of interest. So GM, a producer of rotary mower blades, recently borrowed $100,000 from each of two banks, Bank A and Bank B. The loans were incurred on the same day when the prime rate of interest was 6%. Each loan involved a 90-day note with the interest to be paid at the end of 90 days. Let's look at the two options. So in the first one, the first in the Bank A, the interest rate was set at 1.5% above the prime rate on Bank A's fixed rate note. Over the 90 days period, the rate of interest on this note will remain 7.5%. So 1.5% plus 6%, this becomes the increment, as we discussed earlier, regardless of fluctuation in the prime rate. The total interest cost on this loan is 1,849, which comes out to be $100,000 borrowed. The total interest that is supposed to be paid with 90 days divided by 365, it applies to only 90 days. So this is the interest that has to be paid, which means that the 90-day rate on the loan is 1.8%. If you directly divide the amount of interest that we are going to pay divided by the amount borrowed, will be giving us effective rate of 1.85. So because the loan cost 1.85% for 90 days, it is necessary to compound 1.085 for 4.06 periods in the year. So the 4.06 periods is basically the 365 divided by 90. So if you divide the 365 in 90 blocks, 90 days blocks, that will be around 4 blocks, a quarter almost, and then subtract 1 to find its effective annual interest rate, which is 7.73. Now this is the annual rate, so we annualize the 1.85% for 90 days to 7.73 as an annual rate. Annualized rates are important for comparisons. Now Bank B set the interest rate at 1% above the prime rate on its floating rate note. The rate changed over the 90 days will vary directly with the prime rate. Initially, the rate will be 7%, so it's 6% plus 1%. But when the prime rate changes, so will the rate of interest on the note. For instance, if after 30 days, the prime rate rises to 6.5, this was 6%, now it's 6.5%. And after another 30 days it drops to 6.25%. The firm will be paying 0.57% for the first 30 days, 0.6167%. So let me write it here, then it comes to be 0.616% for the next 30 days, and then in the end it will be paying 0.596% for the last 30 days. Now it's the 90 days, and this is 3 terms, 30, 30 and 30, which is given here. So its total interest rate cost will be, if you add all these three together, you will have, and apply it, it will becomes $1787, and the interest rate, which is implied interest rate, which comes out to be is 1.79% by dividing 1787 to the total amount that we borrowed. This is the difference between fixed and floating rate computations. Again, assuming the loan is rolled over each 90 days through the year under the same terms and circumstances, its effective annual rate is 7.46%. Effective annual rate we calculate by, and clearly in this case the floating rate loan would have been less expensive than the fixed rate loan because of its generally lower effective annual rate. So when we calculate the EAR, we can compare the results to figure out which one is more expensive and which one is cheaper. So what is a line of credit? A line of credit is an agreement between a commercial bank and a business specifying the amount of unsecured short-term borrowing the bank will make available to the firm over a given period of time. A line of credit agreement is typically made for a period of 1 year and often places certain constraints on the borrowers. The interest rate on a line of credit is normally stated as a floating rate, the prime rate plus a premium, which depends on the firm's credit worthiness. The higher the credit worthiness, the lower the interest rate. A bank may impose operating change restrictions, which are contractual restrictions that a bank may impose on firm's financial condition or operation as part of a line of credit agreement. It also depends on the magnitude of the finance as well. Bigger firms have more flexibility compared to a similar line of credit to smaller firms or less established firms, and they will face more restrictions. So a compensating balance is required, checking account balance equal to a certain percentage of the amount borrowed from a bank under a line of credit or revolving credit agreement, so that a complete default can be avoided by the bank. So e.g. graphic design firms has borrowed 1 million under a line of credit agreement. So it must pay a stated interest rate of 10% and maintain in its checking account in a compensating balance of 20% of the amount borrowed, or $200,000. Now that is 1 million multiplied by 20% of the compensating balance, give you $200,000. Thus it actually receives the use of only 800,000 at any point of time. To use that amount for a year, the firm pays interest of 100,000. You'll see this is 10% of $1 million. The effective annual rate on the fund is therefore 12.5%, which is 100,000 that we pay divided by the 800 that we actually uses the money, and this gives us 12.5%. So this is what we use. We don't use entire $1 million, 20%. stays in compensating balance or in checking account, and it's kind of a security or guarantee that the bank will not lose all the money if in case something bad happens. So we pay more for using less money, hence it's a higher interest rate. Stated interest rate is 10%, but effective is 2.5% higher. If the firm normally maintains a balance of $200,000 or more in its checking account, the effective annual rate equals the stated annual rate because none of the million borrowed is needed to satisfy the compensating balance requirement. If the firm normally maintains 100,000 balance in its checking account, only an additional $100,000 will have to be tied up. So if compensating balance falls, the effective interest rate also falls. If compensating balance increases, the effective interest rate also increases. An annual cleanup is the requirement that for a certain number of days during the year, borrowers under a line of credit carry zero loan balance, that is, owe the bank nothing. This is to ensure that money lent under a line of credit agreement is actually being used to finance seasonal needs. Then comes revolving credit agreement, a line of credit agreement, credit guaranteed to a borrowed by commercial bank, regardless of the scarcity of money. So, as the name says, it's a credit agreement. It is guaranteed in the sense that the commercial bank assures the borrower that a specified amount of funds will be made available regardless of the scarcity of money. So so even if in these rare or extreme situations where the credit market is dry, still the money will be provided to the firm. A commitment fee is the fee that is normally charged on revolving credit fee. So it's basically the cost of credit agreement, and it also often applies to the average unused portion of the borrower's credit line. This fee often applies to the average unused balance, and it is normally about 0.5% of the average unused portion of the line. So let's look at an example. And REH company has 2 million revolving credit agreement with its bank. Its average borrowing under the agreement for the past year was 1.5 million. So the bank charges a commitment fee of 0.5% on the average unused balance. Because the average unused balance portion of the committed fund was $500,000, so it's basically 2 million minus 1.5, so $500,000. So this commitment fee for the year was 2,500, which is 5% of the $500,000. Now REH also had to pay interest on the actual 1.5 million borrowed under the agreement. Assuming that 11250 interest was paid on the 1.5 million borrowed, the effective cost of the agreement was 7.67%. So this is added part of it with the commitment fee. Although more expensive than a line of credit, a revolving credit agreement can be less risky from the borrower's viewpoint because the availability of fund is guaranteed. So in rare situations, this will be used more than normal situations. So with this, we finish the session one. In the second session, we are going to look other parts of the credit lines and the loans, etc. Thank you.